Okay, so you're a high net worth individual and you want a safe yet market outperforming investment portfolio. Now, you should be working with a talented wealth manager if you want to achieve this, but if you're adamant that you want to do this yourself, I'm going to give you the keys to the same investment strategy that I use, and that's what's also used at the elite level that results in increased wealth protection while creating opportunity for the largest gains. Now, you're probably thinking, who is this guy and why should I listen to him? My name is Daniel O'Loughlin, and I've spent over a decade learning and applying elite investment frameworks to consistently outperform markets. Before launching Seneca Private, I specialised in high-yield bonds at S&P Global. I'm also a chartered alternative investment analyst, I hold a master's in finance, and I published highly impactful research on predicting asset prices that made a significant impact in the field of behavioural finance and investing. I spent years actually applying all this experience and knowledge that I've gained, which ultimately allowed me to quit my job and manage my own personal wealth full-time 4 years ago. And now I share exactly how I do that and also help a small group of entrepreneurs and high net worth individuals with managing their own investment portfolios. So to dive in, there are generally two different kinds of investment managers and the approaches that they take. The first is the typical or average approach. The investment manager makes the same decisions that everybody else is making. It's very safe because, and when I say safe, it's safe for the investment manager because they can't get in trouble for their decisions if the market crashes because he was doing what everyone else was doing. But it results in poor risk management and generally average to lower returns. Most professional money managers receive the same training. They all follow the same courses and their teachers teach the same thing. And I can say this because I've been through all that. I have my bachelor's in economics, my master's in finance, my chartered alternative investment analyst qualification. I've published papers on finance, and I've looked heavily into the financial advisor curriculum and the CFA curriculum. The traditional finance industry is drinking from the same bowl of soup, and you can see them every year underperform, while the people who self-study markets and actually look for the anomalies actually outperform in the long run. And this leads me to the second approach that I'm going to talk about. The second approach is the adaptive approach. You see, markets don't follow the same rules every time. They are constantly adapting because think of it this way. If the playbook remained the same forever, then everyone could just read the book The Intelligent Investor and become rich. Now, for some reason, many money managers base the fundamentals of their decisions based on this book still and bow to the altar of Warren Buffett and value investing, even though Warren Buffett and most value investors have been underperforming for over a decade, if not 2 decades. That's no shade thrown to Warren Buffett himself. He was relatively early to value investing when that was actually an edge you could have in the market, and he profited hugely from it. But now, every financial institution does this analysis, so it's not like anyone has an edge or any secret info. They even publish all this research. So investing on this alone places you among 80% of all the other investors doing this. You become part of the herd, and it results in underperformance and higher risk. So when you apply the Pareto principle to investing, where 80% of the best investments come from 20% of the investment managers, you can find the people that are actively looking for that edge to differentiate themselves from the herd. And ultimately it results in beating the average returns, and combined with an edge in risk management, you can actually become better protected from market crashes like the ones that happened in 2000 or 2007. Take Ray Dalio at Bridgewater Associates, for example. Ray employs a slightly different approach to investing that most others take. Yes, he analyzes companies based on their financials, of course. This is important. But he also places as much value on things like the global macroeconomy and asset allocation. Now, specifically on asset allocation, you see, Ray actually realized that there is such a thing as over-diversification, where you end up owning too many things, which results in reduced returns because your biggest winners don't make an impact or don't make a dent in the returns that you get, all while maintaining the same amount of risk. So it doesn't make sense. So we devised this idea of the Holy Grail investment strategy. The point I'm trying to make here is that Ray took the adaptive approach. He questioned how markets actually work and then profited greatly. Ray's flagship fund only had 4 losing calendar years over 32 years since 1991. And in 2008, where the average hedge fund lost 20%, Ray actually made 9%. If you'd like to look into Ray's approach to investing more, I've left links in the description. This adaptive approach that I've mentioned has allowed me to catch massive trends early, such as Bitcoin in 2017, mining stocks in 2018, the renewable energy boom in 2020, and tech stocks in 2023. Now, obviously, 100% of my investments are not winners, but you have to manage risk just like the casinos do. You maintain a house edge so that you mathematically will win, and then ideally when you do lose, because you will sometimes, you just lose small. So there are 3 main pillars when it comes to investing. There's macro analysis, there's risk management, and then there's investment analysis. So the first thing we're going to talk about is macro. We're going to continue to focus on the Pareto principle. So we're looking for 20% of the knowledge that gives us 80% of the gains. So have you noticed that many companies are often touted as being overvalued? This happens when a company's actual value goes beyond the value placed by financial analysts. But what their fundamental analysis doesn't capture is things like how much money is floating around in the world economy. And this is much more important than how good a company actually is. If there is excess cash flowing around the global monetary system, it has to go somewhere, and that cash ultimately gets funneled into assets. Think about it. Now, before I say any more, the fundamental analysis is important. A company should have a strong fundamental value base, and you shouldn't be investing in companies that don't have good financials, but the price is going up anyways because there's a lot more money in the global economy. Remember in 2020 when COVID hit and everyone was losing their minds about recessions and crashes. The US injected $4 trillion into the economy and then the markets rebounded heavily. And that's not including the stimulus that came from many other countries. So even the bad companies with bad financials were going up in price. It's simple economics. The government increased the supply of dollars so much that the dollar started to lose so much of its value. Therefore, everyone started to rush to put their money into more scarce assets, such as stocks, real estate, cryptocurrency, in an effort to protect their wealth. So what moves asset prices more than anything else? It's not fundamental analysis or value. It's actually a function of the current and expected monetary regime. That's the main driver. Now, what do I mean by monetary regime? I mean how monetary policy is applied over the long term. So if it's heavily expansionary, so low interest rates and an increasing money supply, that means markets will grow. Traditional financial advisors' favorite ratio for an overview of a company's value is the PE ratio, or price to earnings. It captures a company's stock price relative to how much the company is making. And for many companies, it's insanely inflated, causing many investment managers to completely avoid these companies. But guess what? Many of these companies have been posting 20, 30, if not 40% annual returns consistently, despite having a high PE ratio. So remember, if the monetary regime and macro environment is positive, then things like price to earnings matters less. It's currently 2025 and we are currently in an expansionary monetary regime. And we have been since the start of the 2008 recession, where global central banks started printing money. And it has now resulted in this regime called modern monetary theory. Essentially what this is that many governments and economists believe the printing of money does not have any knock-on long-term effects on a country's economy. Now, this doesn't make any sense, but the implications of it means that countries now will print money when needed. So in the event of any market crash in the future, essentially this means that governments will print their way out of any of these problems. It's unfortunately a policy which helps gain votes for politicians, but ultimately ruins a country in the long term. In my 2023 annual investment letter, I recommended an allocation to the company Nvidia, which was already showing astronomical PE levels. The price was at $26 in March 2023. When I released my annual investment letter, and now its price at the time of recording is $130. That's a gain of over 400% in 2 years. Now, would I buy Nvidia now? Probably not, at least not with the same conviction as 2 years ago, but it's a good example of not always following traditional advice. You'll find many YouTube channels saying never invest in a company with a PE ratio above 20, but you'll also find that those exact same channels hardly ever outperform, and in the long run, if you analyze how much money they actually make versus putting your money into an index fund, oftentimes you're better just leaving it in the index fund. So if you develop the skills to actually question the status quo, you'll capture the best opportunities. So if your analysis leads you to believe that the expected monetary regime for the next few years is that of easy money and an increased money supply, you should allocate your investment portfolio more towards growth assets, and especially assets that focus on increasing productivity, such as technology stocks. Now, if you're a high net worth individual, I'm not saying that this is where you should put all your money or that most of your allocation should go towards growth stocks, but it does mean that you shouldn't shy away from these things and allocate at least a portion of your net worth towards these. Now, let's talk about the most important thing in investing, managing the downside. It's the real differentiator between those that win in the long term and those that only win sometimes. Most risk can be avoided with diversification, but its meaning, just like most things in investing, has been widely misconstrued. So here's the current definition of diversification in investing. Spread your investments across as many different assets as possible. Now, this is easy to make sense of, such that no individual investment can affect you negatively. However, if you dig into the actual practice of this, it cuts off all opportunities of any outperformance and does not achieve efficient risk management. there's a point at which diversification becomes over-diversification. Let me give you an example to simplify this. Let's say you have a portfolio of 20 assets and a portfolio of 100 assets, invested proportionally equal for the sake of this example. Now, if you've applied good investment analysis, you'll have identified some winners that may achieve above 30% annual returns. Well, if you have a portfolio of around 100 assets, which often is the case when you're investing in index funds or with financial advisors, you're not going to feel any of the benefit from any of the big winners. And the market on average usually returns 8%. So that's not going to move the needle much on your portfolio of 100 assets. Whereas if you have a portfolio of, let's say, 20 assets, the handful of companies that outperform end up significantly growing your portfolio. Now, you may be thinking about the downside and thinking, well, if I have 100 assets, at least the risk is lower than having 20 assets. It's not the case. Let's look at the downside. It's important to note that in times of market downturns, stocks and other assets become heavily correlated. Therefore, when the downside does come, everything goes down. So if you're efficiently diversified and your investment analysis is strong such that the companies you've invested in are good, the downside you would face in a basket of 20 uncorrelated assets versus a basket of 100 assets will be very close. So to summarize what I said, you will likely lose a similar amount of money in a downturn when holding a basket of 20 assets versus 100 assets, but in times of a market uptrend, the basket of 20 assets will outperform the basket of 100 assets. As per Ray Dalio's holy grail of investing, your diversification becomes more efficient when you balance out asset correlations. For example, a stock may move downwards in times of a market crash, but an investment in a completely separate asset, such as gold, might end up going up. And if your diversification is balanced correctly, you can even sometimes make money in a down market. Now, you also want to be very specific on how you allocate to each investment. Later in this video, I break down a simple approach the average new high net worth individual investor should take. But when choosing assets, specifically stocks within the portfolio, you should allocate based on the probabilities you assign of that investment being a net positive and on the risk-reward ratio. For example, if you identify a stock which you are nearly sure it will be higher over the next 5 years, and you also believe that it will be multiples higher, then you should consider allocating a higher percentage towards the stock compared to the others which you might be less confident on. Another important point to note is don't be afraid to let your winners run. There's this concept in investing called rebalancing, and it's something that financial advisors typically do. So what they essentially do is when an asset goes up in value and it's been profitable, they will sell it so that it doesn't make up too much of your portfolio. For example, let's say you invested in a tech stock and it grows higher than most others in your portfolio. They will sell, let's say, half of it so that it's the same size as when your portfolio began. Then they will allocate the money that they just sold into an asset that is now a smaller part of your portfolio and likely has lost money. So really what they're doing is they're selling the winners to buy the losers. It's like cutting the flowers and watering the weeds. It's done by nearly all pension funds and many traditional financial advisors. So it's something to look out for when you're managing your own portfolio and learning about investing. Rebalancing isn't a catch-all strategy that works all the time. It's important to rebalance if, let's say, an asset has gone up multiples in value, then you possibly are holding a lot of risk. So maybe cut it down and hold it in cash or allocate it to another investment that's going positively. But ultimately what you're trying to do is let your winners run and cut your losers early. So now let's also talk a little bit about risk and reward. You're always trying to balance risk and reward. So you need to set yourself some limits on how far you might allow an investment to fall in value by, at which point you know it's time to cut your loss. And so to create these limits based on data, there's a few approaches that we can take where we can sell such that it saves us from selling too early in case a rebound does happen. There's nothing worse than selling an asset and then seeing it suddenly grow the moment you sell. Some quick-fire, easy-to-use methods include using moving averages and Fibonacci retracements on charts to give you a general idea where the buying and selling are happening on an asset and where the rebounds tend to occur. This isn't an exhaustive list of the tools that you can use, but they're some of the easiest that you can learn to apply, and they tend to work quite well. If you'd like to learn more about these specific methods, you can find plenty of tutorials on YouTube. So typically you would want to sell assets as they break past these levels shown in the moving averages or Fibonacci levels. Anyways, overall, the concept of risk management deserves so much more attention, but since this video is primarily a best practices overview, I'm going to leave you with just one more important aspect of risk management. Always calculate the worst case scenario. For some assets, this can mean losing over 90%. In the dot-com crash of 2000, even Amazon stock dropped by 95%. Granted, its risk profile was much higher back then, but you really need to become familiar with what can happen and what has happened in the past so that you can protect yourself. Now, by the way, if you want to build an investment portfolio that includes these strong risk management principles, while including the asymmetric investment opportunities, but you don't have the time to do it all yourself, you may benefit from exclusive access to a private wealth desk with Seneca Private. If that's something that might interest you, check out the link in the description or visit senecaprivate.com/apply. Anyways, back to the video. So now let's talk about investment analysis. Good investment analysis creates opportunity for the few in the know. Now, because there's two kinds of investment analysis, there's the kind that you just follow the book and do what everyone else is doing, which results in average or underperformance. Or you can be fanatical about markets and look for an edge that results in more of a safe portfolio and also one that will outperform. So that's the differentiator. If you want to truly become good at investment analysis, you need to have the mindset of being contrarian and be able to look where others don't. I only know a handful of investors that know how to take this adaptive approach, but it shows in their performance. Although, unfortunately for investors, it's not that easy to get access to them. I'm going to give another example of how the traditional money management industry is failing people. Have you ever heard of the phrase, past performance is not an indicator of future returns? By law, all investment securities and trading platforms have to display this in their marketing materials. Additionally, this is taught in investment theory books, such as The Intelligent Investor, where they say investing based on price momentum is the same as gambling. I've actually studied the financial literature and the data behind this, which is how I approach everything that I do. Actually, it's the final note that a great lecturer I had once left us all with. Always go to the source, which I apply to every bit of news that I read, every opinion or fact that I see. You should always go deeper than what books, people, or the media tell you, and it's important to see both sides of every single opinion. You should always be looking for empirical evidence and always try to prove your own hypothesis and others wrong. That's how we find the best investments. So, if you actually read into the academic literature, there's plenty of evidence to show that price momentum, more often than not, is indicative of further movement in the same direction, at least in the medium to long term. It doesn't even take academic literature to prove this. Just look at a bunch of charts yourself. Stocks that tend to go sideways for a long time. Stocks that are going down tend to go down, and stocks that go up tend to continue going up. Look at Amazon, look at Microsoft, look at Apple. Now, obviously, price momentum has no relevance to using it in the short term. But in the long run, yes, there's going to be ups and there's going to be downs. But as I said earlier, as long as we're in an expansionary monetary regime and the fundamentals of the company doesn't change, then there's no reason why the direction of the stock price is going to change. So that's my first recommendation. Never bet against stocks with positive price momentum. Now, I want to mention that traditional finance isn't wrong about everything. For example, fundamental analysis is hugely important. If the financials of a company is bad, you don't want to be investing in it. Simple as that. Our goal is to analyze every aspect of an investment. You want to weigh the entire picture up. And if the majority of our research is positive, then it's more likely going to be a good investment. So my disdain towards value investors is solely that the financials of a company should not make up the entire investment thesis. Yes, it's hugely important, but it needs to be included in the overall decision-making process. Now, there's no way I can teach everything there is to know about advanced investment analysis in just one YouTube video. So if you'd like to explore a few more of the investment factors that have led me to achieve 20, 30, and even sometimes 40% annual returns in the stock market since 2015, feel free to check out the video that's appearing on the screen right now. Now, there was a lot in this video, and you've probably realized you have years of study and experience to accumulate before you actually get very good at investing. It's quite disappointing to think of how negligent and lazy most money managers are, but it's not necessarily their fault because they're falling deeply into things like the confirmation bias trap, where most media and books and even their peers confirm that they're doing the right thing. So psychologically, I understand, but when you're managing other people's money, it just seems a little careless not to strive to be a little better. But the silver lining in all of this is that it's what creates opportunities for those that search for the truth and apply actual data to their investing approach. So if you're a high net worth individual and you don't want to spend all this time analysing markets and spend more time on the things you're actually good at, well, at Seneca Private, we've launched what we call the Private Wealth Desk. It's an exclusive service that we can only offer to a small group of like-minded people, entrepreneurs and high-impact founders, where we can build you an investment portfolio that also includes asymmetric opportunities, but also gives you direct access to me as your personal chief investment officer. So if you're interested, you can click the link in the description or visit senecaprivate.com/apply. And I look forward to seeing you in the next video.